Good morning, listeners. I'm Noah Mercer, and you're tuned in to the FinMonkeys Morning Brief. We've got a busy day ahead. Yields are climbing, stocks took a breather, and everyone's eyes are on that June jobs report. Let's dive in. First up, Treasury yields are nudging higher as investors brace for the upcoming employment numbers, a move that hints at stronger growth or a higher rate outlook. Next, after 6 straight days of gains, U.S. equity indexes slipped, showing how quickly momentum can reverse when traders shift to cash. Both stories set the stage for today's market rhythm and will shape how portfolios react to the jobs data later this week. What's really framing the day is the twin dynamic of higher yields and a modest equity dip. As Treasury yields rise, the market is pricing in the possibility of stronger economic growth or a more hawkish stance from the Fed ahead of the jobs numbers. Meanwhile, the equity pullback signals that investors are ready to lock in gains and hedge against any surprise in the labor data, a classic case of sentiment shifting from risk-on to risk-off in a matter of hours. Turning to the policy backdrop, the Fed Chair Warsh reminded us that the central bank's priority remains price stability, underscoring that monetary policy will stay guided by inflation rather than political pressures. Adding to that, Goldman Sachs' latest rate outlook points to the Federal Reserve holding rate steady for the next several years, suggesting a relatively stable borrowing cost environment. And looking at the futures market, a tentative opening is forming as tech stocks continue to. That's the FinMonkeys Morning Brief for today. The next thing to watch is the June employment report and any Fed commentary for clues on future rate moves. Thanks for listening to FinMonkeys. We'll be back tomorrow with the next market setup.